Hey everyone, welcome back to Ticker Shock. I'm your host, Dave, and today we're tackling a titan of the pantry that just got hit with a bombshell. What happens when a food giant, home to brands like Heinz and Kraft Mac and Cheese, decides to split itself in two? And what happens when even the legendary Warren Buffett says he's disappointed? Get ready because Kraft Heinz is on the chopping block. The big news broke on September 2025. Kraft Heinz announced it's unwinding its 2015 merger, splitting into two independent, publicly traded companies. This effectively means the food conglomerate that was created a decade ago is now coming apart. The goal? To simplify operations, unlock growth, and better allocate capital. One new company, tentatively named Global Taste Elevation Co., will focus on premium brands like Heinz and Philadelphia cream cheese. The other, North American Grocery Co., will house brands like Oscar Mayer and Lunchables. Sounds strategic, right? Well, not everyone thinks so. Warren Buffett, whose Berkshire Hathaway orchestrated the original merger and still holds over a 27% stake, openly expressed his disappointment, implying that you don't fix a mistake by making another one. Ouch! The market reacted immediately, with Kraft Heinz stock, KHC, tumbling 7.5% in late afternoon trading, making it the worst performer in the S&P 500 that day. So, who is Kraft Heinz, really? This company, founded back in 1869, is a global powerhouse in food and beverages. They sell everything from condiments and sauces, cheese and dairy products, to meals, meats, and coffee across the United States, Canada, the UK, and internationally. In fiscal year 2024, they pulled in $25.85 billion in yearly revenue, though that was a decrease of almost 3% from the prior year. Look ahead, analysts expect a rebound, forecasting $3.04 EPS for 2025, which would be a significant 34.5% jump from 2024. Their biggest moneymaker is Taste Elevation, bringing in a massive $11.37 billion, or 44% of total revenue. Easy Ready Meals is next at $4.75 billion, followed by meats and hydration. Geographically, the United States is their core market, accounting for $17.77 billion, with the rest of the world contributing another $5.02 billion. Now let's get into the real shocker. How does this split and Buffett's disappointment actually hit Kraft Heinz's bottom line? We're going to walk through the math step by step. First, understand that this split impacts all of Kraft Heinz's segments and geographies. It's a massive organizational overhaul. The company has already seen 7 consecutive quarterly sales declines, and a strategic split, while potentially good long-term, introduces major short-term disruption. So, how do we quantify that immediate impact on earnings? For the next quarter, we're estimating a modest but significant 1.5% revenue decline, simply due to the internal focus shifting away from sales execution towards this complex separation. But here's the key part: operating leverage. Kraft Heinz is a huge packaged foods company with massive fixed costs. Think factories, complex supply chains, and big marketing budgets. This means for every 1% change in revenue, their operating income and thus earnings change by a magnified amount. We're using an operating leverage multiplier of 2.0. So, if we take that negative 1.5% revenue hit and multiply it by our 2.0 operating leverage, we get an estimated negative 3% hit to overall earnings. To put that into dollars and cents, based on their average annual EPS forecast for 2025 of $3.04, that negative 3% earnings hit translates to about a 9 cents impact on their EPS. That's nearly a dime per share lost just from the immediate operational friction of this announcement. We've run the numbers for different scenarios too. A no-impact scenario, of course, means $0 EPS impact. Our moderate impact scenario, with that minus 0.09 EPS hit, is what we're assigning a 60% probability to. And in a high-impact scenario, if revenue drops 3%, that could lead to a minus $18 EPS hit. And what about the market's reaction? Since the news broke on September 2nd, KHC shares plummeted between 6.7% and 7.5% in a single afternoon. The market clearly sees this as a negative in the short term, likely overreacting slightly given the magnitude of change and the negative sentiment from a titan like Buffett on top of the company's already struggling revenue trends. So, what's the final verdict from Ticker Shock? Is this good, bad, or neutral news for Kraft Heinz? Based on the immediate market reaction, the operational complexities, the additional separation costs that could reach up to $300 million, and the short-term revenue headwinds, this is unequivocally bad news for Kraft Heinz's stock in the immediate future. While there's a strategic long-term vision to unlock value, the path there is going to be bumpy, costly, and uncertain. For my take, considering the immediate stock drop, the vocal disappointment from a major shareholder like Warren Buffett, and the significant short-term operational challenges ahead for a company already facing revenue declines, I'm putting a hold rating on Kraft Heinz KHC for now. The long-term picture could be brighter if the split truly unlocks value, but the current headwinds are strong. It's a wait-and-see situation, and I'd exercise caution before diving in. That's all for this episode of Ticker Shock. If you found this insightful, hit that like button, subscribe for more deep dives, and ring the notification bell so you don't miss a beat. Remember, this show is for educational purposes only and is not financial advice. Always do your own research before making any investment decisions. See you next time!